Here is the most common story in the stock market. A man buys a stock because he heard a rumor it would jump 10% in a week. He buys it for a trade, but the stock drops 10%. He doesn't sell. He says, "Well, it's a good company, I'll hold it for the long term." Congratulations. He has just committed the deadliest sin in the business of investing. He has become an involuntary long-term investor. He entered as a trader and stayed as a bag holder. In the corporate world, this is like opening a pizza shop and then suddenly deciding to become a real estate holding company because you couldn't sell any pizza. It's a recipe for bankruptcy. Welcome back to You Inc. Today, we make a hard choice. Are you a hunter or a farmer? Are you a merchant or a landlord? We are going to decide your business model, short-term trader versus long-term investor. You can be either, but you cannot be both in the same trade. Let's look at the first business model, the trader. Think of a trader like a high-frequency merchant. Your goal is inventory turnover. You don't care about the quality of the product, the company. You only care about the price difference. You buy potatoes in the morning for $1 and sell them in the afternoon for $4.10. You don't care if the potato farm goes bankrupt next month. You only care about today's price action. The pros. You can generate cash flow quickly. You can make money in bear markets by shorting. You get immediate feedback. The cons. It is a high-stress job. You are competing against supercomputers and algorithms. Taxes and transaction costs eat your margins. And most importantly, it requires your time. If you stop trading, the money stops coming. This is not passive income. This is a high-performance job. Now the second model, the investor. Think of an investor like a real estate holding company. Your goal is asset appreciation. You buy a building, a company, because you believe the rents, earnings, will rise over the next 10 years. You don't care if the building's price fluctuates next week. You care about the tenant's ability to pay. The pros. Time works for you. Compound interest is on your side. Taxes are deferred until you sell. And crucially, it is passive. You can make millions while you sleep. The cons. It is boring. It requires immense patience. Your capital is locked up for years. You look stupid during bubbles when traders are making quick money. This is not a job. It is wealth ownership. Which model fits You Inc? It depends on your capital, your time, but mostly your temperament. Let's do a quick audit. Question 1. Reaction to loss. If your stock drops 5% in an hour, do you feel adrenaline and look for a stop loss? You might be a trader. Do you feel excited to buy more at a discount? You might be an investor. Question 2. Source of confidence. Do you trust charts, patterns, and psychology? Trader. Do you trust financial statements, products, and management? Investor. Question 3. Lifestyle goal. Do you want to beat the market every day and feel the thrill of the win? Trader. Do you want to ignore the market and let your money work while you go fishing? Investor. Be honest. If you are lazy but try to trade, the sharks will eat you. If you are impatient but try to invest, you will sell at the bottom. The reason You Inc. must choose a model today is to avoid style drift. Style drift is when a value investor buys a meme stock because of FOMO. Style drift is when a day trader holds a losing position hoping it comes back. This confusion destroys portfolios. If you are a trader, your boss is the stop loss. You execute without emotion. If you are an investor, your boss is the business fundamentals. You hold through volatility. If you mix these rules, you get the worst of both worlds. You take the trader's risk with the investor's slow returns. Now, the million-dollar question. Can You Inc. have two divisions? Can you be a trader and an investor? Yes, but with one strict rule. Total separation. You must have two separate accounts, two separate strategies. Account A, the vault. This is 90% of your money. It follows the long-term investor model. It never touches risky trades. Account B, the casino. This is 10% of your money. It follows the trader model. This is for satisfying your itch to gamble or test your skills. If account B goes to zero, it does not affect account A. Never cross the streams. Never transfer money from the vault to the casino to cover a margin call. That is embezzlement from your own future. It is time to decide. Are you running a high-speed trading floor Or are you running a quiet asset management firm? Neither is wrong, but not deciding is fatal. Write it down in your business plan. My primary business model is X. Once you choose your model, you need a set of laws to keep you on that path. You need a code of conduct that prevents you from drifting. In the next episode, we are going to write the constitution of your company. We will create your 10 commandments of investing. These will be the laws that keep you, Inc., honest, profitable, and alive. Choose your path, and I'll see you in the next video.